Welcome to the daily update, where I'll go over the action in the market for Friday, February 14th, and we'll see how things look for Tuesday, February 18th. The market will be closed for a 3-day weekend in observance of President's Day on Monday. Well, retail sales came out and it was weaker than expected. That drove interest rates down. It gave some support to stocks, but we ended up closing just a little bit lower. There could be some geopolitical events that happen over the weekend in Israel with the whole hostage process there. And so the market just kind of drifted a little bit and didn't really show much conviction in Friday's session. We're still seeing this tug of war between the smart money, which now is pulling back a little bit, but still looking really strong, and our indicators, which some are looking more positive, some are looking a little bit more negative, and it's giving us kind of a mixed picture across the board. So, right at the open, we did have a higher open, but prices hit resistance at the 61.25 level. Then we retraced back down from that, actually dropped below the unchanged level to go negative. Then we chopped sideways, got back above the unchanged level, and just drifted and ended up closing slightly negative. We were down 0.01% on below average volume, and we're still looking positive when you measure things based on moving averages, the 20, 50, and 200-day moving averages. Price is still above all three of those, and interest rates are falling, at least in Friday's session. We declined on Thursday, but then we kept going down and actually gapped lower below that 4.5% level with the 10-year yield. And I mentioned the geopolitical concerns that we'll be watching for to see if anything develops there. Okay, some comments. The retail sales report did come in weaker than expected. And on a short-term basis, though, we're still seeing some good momentum. It's pulling back a bit, but it's different than what we had been seeing with this trendless environment that we're still dealing with. The Stoke RSI, Williams Percent R, CCI 14, and stochastics. Those are momentum indicators suggesting that on a short-term basis, okay, we're looking a little bit more positive. And then we have our three smart money indicators, accumulation distribution, Chaikin money flow, and Chaikin oscillator. Those are pulling back now, and I'll show you charts of all of these. In the intermediate term, we're still looking positive with the Sean trend meter. No change to the current scenario where now a lot of folks are like, oh my gosh, retail sales is such a huge part of the US economy. Is that going to really hurt things? But the market is still anticipating a soft landing, meaning that we will not go into a recession. The dollar was down, interest rates were down. We're at 4.48% now with the 10-year yield, where we had been at 4.54%. Sentiment is now negative. We ticked down. We're at 44, where we had been neutral at 47. We're still not trending, but we're positive. The green line is above the red line, but we're still declining with the ADX. We're below 20, we're below the moving average. And because of the really not much conviction, I have mixed for the bias, and momentum is also mixed as we're still dealing with this trendless environment as well. So the economic reports, the retail sales report did come in weak, and industrial production also came out, which showed growth, but not including manufacturing or mining. And that's a big part of the manufacturing sector for industrial production. So here's some charts. Here's retail sales. Where you look at it on a year-over-year basis, we're pretty much flat, not seeing that much of a change. It's the month-over-month where we had been going up and positive. Well, we really dropped down with the latest reading. Then industrial production, that's blue. That's actually picking up, and capacity utilization on a year-over-year basis is still showing some improvement. But then we look at it this way, and we're coming up. We want to get to that 80% level. That means that we're at full capacity at that point. We are improving, but we're still below the 78% level. And on a month-over-month basis, it was still up, but really dropped off. Then business inventories also fell. There's a lot of things now going out the door. They're not necessarily hanging on to things. They're trying to get it out. That could be some of the tariff action that's going on there. All right, then looking at retail investors and their allocation to stocks, bonds, and cash, not really any surprise here. Most are in stocks. with some, that's the light blue line here, that's cash, and then some are in red, which are bonds, and they're not as attractive right now. But the real focus is growth, and so that's where most investors tend to put their money. And here's a whole convoluted thing down here. It just says the Valentine's Day indicator. I mean, they have an indicator for everything. It's flashing green, not red. And this is looking at the year to date return and then what will happen the rest of the year using Valentine's Day as the cutting off point there, where the average is 13.7%, and that's also the median, and we're up 93.8% of the time. So we're positive so far on the year, and that does bode well for things going forward. Where down here, we're looking at the average of 7.7% with the median of 9.4%, up 73.3% of the time. Then this is where are folks allocating things? And yeah, even if you have a pension or if you're using insurance, you're still in the stock market, and that's where most people are at. And then this is equity, including ETFs and mutual funds, and then cash and money markets in the gold area here. And then these are bonds, which still are just not as attractive to folks, either the blue line or the dashed blue line. It's still focused more on the growth areas, and that has been stocks. Okay, this you can pause this and look at it. It just says a new high in real gold price, taking inflation into account. And this is just different events that have happened than what gold was doing at that particular time. Then the aggregate earnings surprises, going back here to the great financial crisis where everything was being revised down, we're still looking okay over here on the right-hand side, and that is more positive for the market. Capital expenditure by the Magnificent Seven stocks, and just showing that a lot of this in different companies that are listed here and what they're spending. They're putting money back into the economy. They're doing a lot of, you could say, research and development, but also expansion and growth and developing AI and new technologies. Then gold consecutive weekly gains here, really looking pretty good. And there's been a lot of buzz around gold, and there's a lot of people that really like gold, and they've waited now for over a decade for it to perform well, and now it's been performing quite well. Then this is just saying, okay, inflation no longer cause for concern. Okay, who knows? This is just when companies come out with their earnings reports, they flag key words during that, and there's not an awful lot of mentions of inflation during those earnings report calls. It's a lot about AI and things like that. I didn't spend any time on Twitter, but here's looking at the intraday chart. And really, things started to look a little bit better as of Wednesday. We gapped lower. That's when CPI came out. We carried through with that in Thursday, and that's where we saw the bulk of the gains. Actually, all of the gains, because we closed down a little bit on Friday. But not a lot of conviction, just kind of treading sideways. Intraday, we are closing up shop for the weekend, and it'll be a 3-day weekend here. And we were seeing an improvement as we were coming into the cash session. We actually were drifting lower and then started to come back. Still looking good here with the intraday chart of large cap growth versus large cap value. The blue line's above the red line. Still looking good here with the S&P growth to value ratio. It's in an uptrend. End of day growth was up where value ended up being down, and it was down less for the mid caps, but down more for the small caps. So looking at the small cap growth to value ratio, it is coming down a little bit here and starting to chop sideways, even though it's still in an uptrend. And mid cap growth to value looking a little stronger, but not recently. And of course, the indexes haven't really been going anywhere either. S&P growth to value did come down a little bit on the end of day chart, but this is looking stronger than the other two, for at least for right now. Saw a bit of an improvement with the growth versus value ETF coming up into the top end of the rainbow. Discretionary to staples still looking pretty strong here. So these are areas that are more positive and they're under the surface. And when we see growth outperforming value, discretionary outperforming staples, that's more positive for the market. And large cap growth ETF was up 0.25%, still looking pretty solid there. As far as our trend, the short-term trend anyway, we're trying to level out. I wanted to include this one first. If we cross above the moving average, that could signal a strengthening trend in the short term, and then it won't officially be a trending environment until we get back above this blue line, which is at 20. But we are positive with the green line above the red line. Intermediate term, still going down here below the moving average and still getting a very low reading, but we're still positive with the green line above the red line. Volume did drop off in Friday's session. Looking at sentiment, even with the slight down day, we still are declining here with the VIX on a closing basis and also the bar chart. We're getting underneath these moving averages. And also seeing a little bit of an uptick on a closing basis with the VIX of the VIX, the volatility of the VIX, but still maintaining below the moving averages. And the momentum for the VIX still continues to be down, which is positive for stocks. Still getting a high reading with the skew index. And this is a variation of the VIX, and it's calculated using out of the money options, but we've been up in this red area now for quite some time. We declined with this fear gauge, and we were up with this other fear gauge. So a little bit of a contradiction there. And we really went up with the equity put call ratio after Wednesday. Then Thursday, boom, we really started to come down, and then that trailed in Friday's session, even more down lower. So we're going back down with the 5-day chart, and we're also declining just barely here with the 10-day chart, which is more positive. I haven't shown this in a while. This is the risk off versus risk off ratio, risk on versus risk off. We're starting to go back up where we're just chopping around for all of 2025. We really haven't shown a lot of conviction, but recently we are going back up with this ratio, which could be more positive for stocks. And this is going up as well. This is the ratio between large caps and small caps. That is favoring large caps currently. And coming up a little bit, but still in this band here when we look at volatility risk premium. Advanced decline line still looking positive here based on price and volume. Showing a little bit of improvement, but still below zero with our advanced decline over the last 10 periods. And improving here with the new highs exceeding new lows, trying to turn back up with the 5-day and still flat to slightly going back up with the 10-day. Slightly above zero with the advanced decline ratio, both the short term and intermediate term. This is smart money indicator number one. We are pulling back. We still could be kind of far away from the moving average, but we're still positive because we're above an advancing moving average. And the chicken money flow, getting a very high reading here. And it doesn't necessarily mean a reversal. It just might mean that we slow down, even though we haven't really been going all that fast to begin with, since there hasn't been much of a trend. This is actually turning a little more negative, but it's still extreme positive. The chicken oscillator is dropping below its moving average after getting above this green line. Vortex is improving with the green line above the red line. And I haven't shown the advanced decline lines for a while because we've just been chopping around. If you look down here based on volume with the S&P advanced decline line, the cumulative, we're looking pretty good there. Volume is actually outperforming price right now, and that could be positive when volume does lead price. Seeing a little bit of weakness here when we compare the S&P to the NYSE advanced decline line. It went down just a little bit. And then we look at the NYSE cumulative advanced decline line here. That's looking pretty good, but not really breaking out. And we look at the NYSE advanced decline line. This is looking better too. But our other NYSE advanced decline line, it's just still chopping sideways. That's why I show two different versions of the same thing. They're calculated just a little bit differently. Then we break it out based on common stock. Doing okay, but chopping around. But we're doing better here based on volume. Seeing things still mainly positive with our advanced decline line studies. We're still above the moving averages with the NYSE common stock, S&P mid caps, and we're right on the moving average with the small caps. And we were looking a little bit better and then a little bit worse and now a little bit worse again here with those stocks inside the S&P above their 20-period moving averages. That's short term. It ticked down just a little bit and we're below 50. Where we're still above 50 with those stocks above their 50-period moving average. We ticked down but still above 50 with the 100, and we ticked down with those stocks above their 200-day moving averages. So not much really to talk about. We didn't set an all-time high. We're close, but we're not quite there. On the bottom, we did drop down below average with volume. We declined a little bit with the 20. We're flat with the 50 and still advancing to slightly flat with the 200-day moving average. And this is the showing that the momentum could be improving here. The Stochc RSI is extreme positive, as is the Williams percent R, the CCI 14 and 20, and then our stochastics in the short term, starting to get extreme in the intermediate term and long term. And still positive with the force index. And we're still tending to go up here with the condition of the short-term trend based on 20 periods. And we're still above the simple and exponential moving averages. So the short-term trend is still positive. We're still in the +2 channel here with our standard deviations chart. That's positive. We came down after being extreme with the balance of power, but we're still getting quite a positive reading. The go, no go has the dark blue bars, which are positive. We're still coming up to the blue line here with our highest high value. This is still looking positive, but the TTM squeeze continues to drop off. Darker blue, declining. We turned back positive with the ease of movement. We were able to cross back above zero. The Erin indicator is just flatlining. It's not picking up much of anything. And the McClellan oscillator, slightly negative, dropping just a little bit below zero here. Can't really see it all that much. We're flatlining here based on price. We were starting to look better, and we're still looking okay based on volume. It's price that's lagging behind right now, which could end up being positive if we're seeing volume leading price. And we're back above zero with the NYSE McClellan oscillator because the broader market was a bit more positive than the S&P itself. So we're just kind of chopping around now with the summation index based on price, kind of chopping to slightly lower based on volume. This is encouraging too. The Swenlin trading oscillator based on price crossing back above zero, and we're continuing to go up here based on volume. And momentum is still positive when you look at the PMO by itself, but we're below the moving average based on price. We're starting to go back above the moving average based on volume. So kind of in the middle now with the PMOs that are rising, still declining with the buy signals, and pretty much flat with the PMOs that are above zero. We're positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. We've had 2 days now, but we're still negative in the short term. We're looking at the slope oscillator, but the MACD is positive. So we look at all of these. The slope, that short term, is negative. We're flat to slightly positive with the TSI. You can see the market's a little confused right now. Still leaning more positive now with the intermediate term trend indicators and still positive, but rolling over here. The KST could be getting ready to cross below the red line. And the Copic curve is improving, but still negative. And here's the Sean trend meter showing that the momentum is still positive there. We're above 50 with the money flow as well as the ultimate oscillator. We're above the moving average with on balance volume. We're above 50 with the RSI 14 and 9. The condition of the intermediate term trend, we're still going up with the blue line and the red line. And we're above all the plotted moving averages here. If you measure things that way, we are positive. The NYSE bullish percent index ticked down just a little bit, but we're still above 50. And the S&P bullish percent index, it's still declining. It's improving, but it's still declining overall. So we would count that as negative since it's below its moving average. And we're declining with the NASDAQ 100 bullish percent index. And I'm still looking at this long-term trend channel here, which could be producing some overhead resistance and has been since we hit that high back in December. We are positive with the Heiken Ashi with the open candles. We're positive with the Kagi chart. It's black and pointing up. The Renko chart has the open blocks. That's positive. And the three-line break continues to be positive. Long term, we're just kind of chopping around right now with our 150 and 200-day moving averages. We're negative in the short term with the mid caps. Everything else is positive across the board and on all time frames. We've switched back to positive now with bonds in the short term, and they're still negative in the intermediate and long term based on price. The dollar is still in a downtrend in the short term. And saw communication, tech, these are growth areas, and the financials, they were up, but all of the other sectors ended up being down. And we saw a BPI cross below 50 with the healthcare sector right after the open. The euro has been bouncing back a little bit against the dollar. It got back above 105. The Nasdaq got above 20,000, and then utilities, which had been stronger earlier on. If you go back about 6 months, they were a real strong area. Then they started to show some weakness. Now they're looking a little bit better with a BPI cross above 70. Seeing a bit of a disconnect here between the weighted and equal weighted version of the S&P. We're kind of declining here with the equal weight version when you compare it to the weighted version. And we're going up with the ratio. That means the S&P is outperforming the equal weight version of the S&P. The Dow is just kind of chopping along sideways, and it's gone from positive to neutral with the diamonds when looking at the Elder's Impulse system. The Nasdaq, it was up 0.41%, and it's been doing pretty good here. Not back to an all-time high yet, but still looking pretty strong. And here we're looking pretty good with the Nasdaq 100. We're still dealing with this R1 overhead resistance point. And we are still positive with the Elder's Impulse system for the Qs. The momentum for the Nasdaq 100 continues to be positive. And then we get into the small caps here where we're just kind of chopping around under the 50-day moving average. We're right at 50 when we look at the other small cap index, the Russell 2000. And then here's the RSI, still below the 50-day moving average, and the momentum is dropping negative. And we're still neutral with the Elder's Impulse system with the small caps. Still below the 50-day moving average with the mid caps here. They couldn't seem to get above that. They're still neutral with the Elder's Impulse system. The Wilshire, the broad market measure, is still looking pretty good there. It was down 0.01%, just like the S&P, and we were actually up 0.03% with the total U.S. stock ETF. Another broad market measure that's still looking pretty positive. The financial sector was up and holding together nicely there. The FANG index looks like it closed at a new all-time high here. These are the really big stocks. Semiconductors haven't watched these in a little while. We came down to the 250 period moving average, and so far we've been bouncing up off of that. This is a huge part of the tech sector, which is also a huge part of the S&P. For these to perform better would help the S&P perform better. And Apple was up 1.27%, getting back above its 50-day moving average. Microsoft still continuing to drop down below its 200-day moving average. Amazon dealing with its 50-day moving average. Meta setting another new all-time high. Google down below its 50-day moving average. Nvidia trying to get back above its 50-day moving average. Tesla, which has been under a lot of pressure lately, was virtually unchanged on Friday. And Netflix setting another new all-time high. Seeing a little bit of strengthening between US and world stocks. When we look at the correlation on a short-term basis, we're still flat with the longer-term correlation. And still in the lower end of the 70s when we look at oil. The dollar's dropping further down below its 50-day moving average, but it's still in an uptrend as measured by the 50-200 moving average crossover. And we dropped down below the 50-day moving average. We're down below the 4.5% level with the 10-year yield. This is an intraday chart where we just gap down below it, and so far we've been able to stay under that, and that could be positive for stocks. Of course, if it goes back up, that'll be more negative. So we're going back up based on price with the 7 to 10-year bond ETF. A little bit of an improvement here, still looking stronger with the Qs to S&P ratio. Not too much strength right now with discretionary to the S&P. We are seeing a little bit of an advance above the moving average with large cap growth versus value. So the large caps are showing a little bit of improvement, but the moving average is still going down. We're declining, but still above an advancing moving average with the mid caps. And we came right up to the moving average only to drop back down with the small cap growth to value ratio. So what's our outlook for Tuesday? Let's see, I had another one. The market will be closed on Monday for President's Day. We're still positive, but we're not trending right now, and the smart money indicators are pulling back. We're going to get the Empire State Manufacturing and the NAHB's Housing Market Index, and then keeping an eye on what's happening geopolitically in the Middle East, what's happening internally inside the U.S. with the executive orders and Doge and all the stuff that's going on there, providing all kinds of news headlines. And here's the economic calendar for the upcoming week. We're on Wednesday. We're going to get the FOMC meeting minutes. Jobless claims are kind of a big deal right now. We'll also be getting LEI, and then on Friday, we'll get consumer sentiment. Here's a look at the upcoming week for the economic reports. Seasonality, February 18th is positive across the board, going back to 2002. And now we're getting into the second half of February, which tends to underperform. When you go back to 1950 and look at the median 2 week returns, they're not very good. And February doesn't do well in a post-election year. And now we're entering the second half of February where it tends to see more negative action than what we saw in the first half. And here's another one. It's February is the worst month in a post-election year. So we are now looking a little bit more negative with the S&P McClellan oscillator and summation index. You can't really see it with the summation index, but we're slightly below zero with the McClellan oscillator. The Copic curve is still negative, even though it's showing some improvement, and we're below 50 with the 20-period moving average study. Still looking pretty positive here, but we're pulling back with our three smart money indicators, and they still could be considered extreme. The growth to value and discretionary to staples ratios are holding up, and the equity put call ratio based on 5 and 10 days are going down. And that means there's less hedging. That tends to be positive. The advanced decline lines are still positive, as is the NYSE McClellan oscillator and summation index. And the oscillators that we use to measure the momentum of the S&P 500, they're kind of drifting. We're seeing a real mixed picture right now. So overall, they have been weakening. But then we saw them go up a little bit after Thursday's session. The Swenlin trading oscillator is looking positive. The parabolic SER for 2 days now has been positive. The vortex is positive. Ease of movement, which is back on the positive list now. The money flow and the ultimate oscillator. And the 50, 100, and 200 period moving average studies, they're still above 50. The financial sector is still positive, and the momentum for the NASDAQ 100 continues to be positive. So our conclusion, we're positive, but we're not trending. The smart money indicators are pulling back. If you don't include the Chaikin money flow, it's still going up and looking rather extreme currently. In the short term, that's where we're not trending, and we're seeing most of the impact with the smart money indicators there. Intermediate term, we're positive but not trending. We are still positive in the long term. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.